Oh, Elon, hi, how you doing? Jay has been trying to reach you, but he's missed you a bunch of times, I understand. Well, yeah, I did give him your number. Was I not supposed to? Uh, he called you 10 times today? Well, he does want a couple tickets on that Mars trip that you're providing for everybody. Yeah, yeah, I know. That's what I told. Well, not exactly, but that's kind of what I told him. The Anyway, so I've been trying to talk to you about this Bitcoin thing, and replacing it with Hoot Loot. Have you seen our Hoot Loot? Okay, well it's the logo of the show, and the thing is, Elon. The other thing I want to talk to you about is this Mars thing again because um, it seems like you can't stand the government. You always hate the regulations like the SEC and all that. And I like, I applaud, a little bit of the rebellion. But on the other hand, that's where all your money comes from. All those subsidies they give you. How can you get away with both? Elon? Elon? Hello? I guess he's gone. Anyway, thanks everybody. Welcome everybody. Welcome back to Markonomics 101 presents Hoot Loot, the place where you go to be informed, be amused, but never be misled. Now, what you just saw moments ago was my last encounter with Mr. Elon Musk, with whom I have quite the rivalry, shall we say. And you're going to find out more about it at the end of today's show because I've got a call scheduled with him. And today's show is called April Fools. Not that I think it's April Fool's Day, but only fools rush into a market this overvalued. So I decided to call it April Fool's today, even though April Fool's is coming up. Okay, so today is Saturday, March 27th, 2021. Please like and subscribe, and we'll be right back with the charts. All right, so welcome back to Hoot Loot, and we're about to go to the charts. Oh, jeez, what's this? Oh, hi, Millie. How you doing? Huh? Upset about what? What? Don't tell me he made you pick up the check again. What is that, the 15th time in a row? What, does the guy not carry a wallet or something? Oh, anyway, you think he's gone a little to the fruity side of life? Is that what you're telling me? Kind of lighten the loafers? Oh my God. Well, what do you think caused that? Um, well, he had the COVID shot the day before. No wonder. No, what wasn't that the night? Didn't we have dinner that night? Oh, yeah, that figures. Never mind why I'm asking. But anyway, how do you know that he's actually really playing for the other team right now? He's in the jacuzzi with Joe Biden and a glass of wine. Okay, gotta go. I will talk to you later. Okay, welcome everybody to the April Fool's edition, and that was Nolan's April Fool joke. I'm telling you, I get the weirdest things that go on around here. So let's go to the charts and check it out and see what's going on in the world. This is the Dow Jones Industrials right here, still confirmed, still confined in a bearish wedge. And while I'm at it, I want to tell you something about a new feature that we're introducing. It's called Learn and Earn. Earn means you get money. Learn means you get knowledge. You get knowledge and you get money. What a deal, huh? So we're going to have that, and we're going to ask a question at the very end of the show, a question that can be answered. It's not a really technical question. If you just aren't lazy like a millennial and you're not in your parents' basement getting stoned and playing video games, you can probably find the answer pretty damn fast, okay? So it's going to be called Learn and Earn. Learn and Earn, and it's going to be at the very end of the show. We will also have a call with Elon Musk at the end of the show, which I just dread because his calls just drive me crazy. But anyway, let's go to the chart. So we talked about the Dow being in a bearish wedge formation, and it rallied a little bit today. Actually, it rallied quite a bit today. And if you wonder why it rallied, now look at the volume. There's no volume on this rally. A huge move, 500 points. You'd think there would be like euphoria out there. No, actually, there was an option expiration day today, and a whole bunch of positions got unwound. And apparently, usually what happens when positions get unwound on options expiration is their balance. In other words, you have, roughly the unwinding does not move the market. This time it did. And that's why I would be very careful about reading too much into this today, this move, because it all occurred in the last half hour. The Dow's up a couple hundred points, all of a sudden it's up 450 in like 20 minutes. So you got to be really careful of those moves. Those are kind of like short squeezes when people just are panicked that they're going to get smashed. And when you hold options, that's what happens. They're very leveraged securities, and that's why probably things move very quickly, because people just couldn't take the pain anymore. I know that very well because I can't take the pain ever, except when I want the pain, in which case I can take a lot of it. So, no, I'm not really into that. Okay, so the NASDAQ 100. Now, we've talked about this kind of leading the market on the way down, and it's completing a rounded top. It has failed to make a new high. The Dow made a marginal new high today, and that kind of gets people really excited. But the NASDAQ is where the action is. It's where the market cap is, and it still has not made a new high. And as a matter of fact, tomorrow, I'm going to bet you, not tomorrow, tomorrow's Sunday. What do I think this is, Bitcoin or something? Anyway, Monday morning, there's a very good chance that that extra half hour that basically got bolstered by people unwinding positions in a hurry, not wanting to get killed, that's going to come right out of the market. So you might see a gap opening on the market on Monday morning. That's a guess, just a pure guess, but it would be ideal for something like that to happen, especially when you had 250 points of just pure nothing, pure air put into the market. And so that air is likely to come out, just like it did from the First Lady when she got her COVID shot. That wasn't very fun. I should sit down the hissing. Oh, jeez. Anyway, the S&P 500 also is making a rounded top, and it's also rallying. It rallies on declining volume, and it declines on surging volume. And I normally don't talk about volume because it just isn't that indicative of a stat, except when it's like this, except when you see rallies and they're just, the volume just goes drip, 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 lower. And when you see a decline, all of a sudden it just surges, just goes, boom, then you got a problem. And then you need to pay attention to volume. Otherwise, all kinds of things could happen and you just don't know. This is the S&P small cap index. This thing has rallied like crazy until recently. What you'll notice now on all these charts, I want to point this out, is that if you look at the 1 year, year over year, okay, they're all up about 100%. For example, the S&P small cap index starts at 600 and went up to 1400 within a year. Okay, now that's after this god-awful pandemic, people dying like flies from the flu, and all kinds of things happening, and they're going to all get mutated, and we need to be vaccinated, and all that kind of stuff. You can't go to work, can't leave the house, can't go through life without a mask. Oops, where's my mask? I better find one. But in any event, this broke down, and that's really critical because it was holding up while the other indexes were holding up, and it's also a sign of speculative interest. And these are very small companies. Well, small comparison to the other ones, but these are basically small caps around roughly $200 to $1 billion. Okay, they're up and coming companies that do something kind of neat. Sometimes they don't, but they're called small caps. And penny stocks, I read. Okay, now I read this, so I don't have an exact measurement. Penny stocks are up 1,000% year over year. Okay, that's got to tell you something right there. Okay, and that, Reddit rebels, I know you had something to do with. Okay, so let's go to the transportation average. This thing continues to go up, which somewhat surprises me. I shouldn't say somewhat; it really surprises me. The reason is it's got a horrendous actually now 3 7-point reverse waves. If I were to draw the third one in there. And this thing is bound to turn around. There's just no doubt in my mind that the economy turns around, and I believe that there are signs that it will, despite the stimulus. That if you transport goods and people aren't buying goods, you're not going to make much money. FedEx is one of those companies. We'll get to that in a minute. This is the Wilshire 5000. The reason I bring this one up is because it is all of the value of all of the stocks of everything traded. And the reason it's important is because this thing too, you can see volume shrinking on the rally, but look at the surge in volume at the beginning of the year, and then the rounded top from the beginning of the year. That says to me distribution, and it says to me that smart money is selling to dumb money. How do you know when smart money is selling to dumb money? Because they're selling high and they bought low. How do you know if someone's dumb money? Because they're buying really high and they're going to sell really low. And they buy high because it's the hip thing to do. Well, it's never the hip thing to lose money, in my opinion, but some people just must love it. I don't know why. Take your money off the table before the table takes your money off of you. That's what I say. That's what you should be doing when you own something that's gone up 100% in a year or more, and we're going to show some that have gone up even more. All right, with that, we're going to go to the US dollar. The US dollar is actually rallying a little bit, and it's actually making a rounded bottom. Now, what's interesting about this is that no one thinks the dollar is going to go up, including me, because I've talked about the dollar just going down and being, basically being a piece of toilet paper the entire time. So I would be among those people who would be dead ass wrong. But if you look at this pattern right here, it's not bad. But to complete the pattern, it does have to go really above 95. So it's a little bit far away from that. But given the sentiment about the dollar, everybody thinking the dollar is going to go down, including me, it could very well go up simply because the short interest in the dollar is at a record. And people are going to have to cover it. So, if you get too overly bearish and people start shorting something, then you get these funny things called short squeezes and things go the other way and they go up the other way really fast because people can lose money in a hurry when you're short. So that's what happens. Now, this one, gold, is one again, another one that I kind of just go, about. And the reason I say that is because, with inflation out there, and inflation is another reason the dollar should go down, but with inflation out there, and the signs of it are obvious, gold should be doing better than that, and it's not. What does that tell me? Well, it can only mean one of two things. It can only mean that either the inflation indicators are wrong, or it could mean that gold is being somewhat suppressed or not participating. Jay Powell himself, my good old friend Jay Powell, who finally got me to admit what the First Lady's first name was on the prior show. You might want to watch that because I'm not going to reveal it today. But the thing is that, we were talking about, I've talked to him in the past about inflation, and gold is usually a good hedge against inflation over the long term. Not against the short term. Against the short term, it sucks as being a hedge, but the long term. I mean, in other words, if you hold it for like 50 years and the dollar depreciates, and the dollar's appreciated ever since the Federal Reserve came into play by 99%. Okay, and then gold's up in the same period about enough to offset that, roughly 100 times. So that's what I mean by longer periods of time. Silver too is looking a little bit better. It's closer to its highs and its lows. And my gut feel is that silver actually will move before gold, and it will move faster than gold, and you have to keep an eye on it. It still hasn't broken down the way gold has. And that's why I still think it's possibly just hanging on there. I just don't want to own something, and I would not recommend owning something, being long something, against a market that's going the other direction. Because that typically means no liquidity. No liquidity means people sell what they have to sell that has liquidity, like gold. Gold is always easy to sell, always liquid. If you have a margin call and you need to raise money in a hurry, you can do it with gold. So, or silver. Typically gold's a little bit easier because it's worth a lot more. Silver, you have to carry around, a couple tankers worth. Bitcoin, I speculated a while ago that it was actually in the head and shoulders, and look at that, it was. And the reason I speculated that before was because everybody loved it. And, I've certainly fallen into that trap of where you have to own something because everybody else owns it, and you're an idiot unless you own it. But you know what? That never works. A better way to be hip is to not own it, deal with that, and make money. Buy when they're selling, sell when they're buying. That's how you buy low and sell high. You don't buy high. You don't buy something when it's trendy and hip and high, because you gotta pray that it's going to go higher still. And I can tell you this as an absolute fact of market trading. Hope is a terrible ally. There's never a greater fool when you need one. I'm usually the greater fool, and when I'm looking for a greater fool, I can't find one except when I look in the mirror. And when I look in the mirror, quite a different thing happens. I go, if I were a woman, I'd be all over me. But, not today necessarily. Well, actually, I'll do it today later. Okay, so let's go to some inflation stuff. This is Commodity Research Bureau. Now, the notion that there's an inflation is completely contradicted by this chart. Commodity prices have, on average, gone up 100% over the last year. Over the last year. So what that means is that whatever deflation occurred during the extended flu season, um, all of that, uh, all of that showed up in higher prices, dramatically higher prices, and those things still have not factored their way through the economy. And we're seeing it in CPI, PPI, and all that kind of stuff. Consumer Price Index, Producer Price Index, government stats, the one you can rely on, those that are calculated precisely and have nothing to do with re-electing the person in office, those ones. Yeah, those are the ones that actually are showing inflation running at 5 or 6%, while the Fed is saying 2.5%. Okay. This 5 years right here for the Commodity Research Bureau, this index has been the classic long run index that measures commodity prices. There are others. Goldman Sachs has one. There's some funds that basically invest in commodities, but this is a pretty good way to look at sort of wholesale commodity inflation. And when you look at this, yes, it has come down over the last few days, but it looks like to me it's just ready to shoot out of a cannon. So that's that. One of the reasons, of course, is crude oil, and crude oil is started to drop below its trend line, and it's gone up 600% over the last year. I think that it could certainly deserve a little pause, and it could be shale oil coming on stream. I don't know, but it comes on stream very fast, and there are a number of shale oil companies out there that can produce an awful lot of oil. There are also a lot of crude oil companies like Exxon, which have lots of shale projects and can vastly expand their production like that. Boy, was that good. I mean, that just have you ever seen it snap better than that? I have not. Let me try that one more time. Boom! See, that one sucked. I guess I can only do it one time. All right, so crude oil, we're going to go on to unleaded gasoline. Now, unleaded gasoline has also shot up, and if you drive a car, like the Beatles song, Baby, You Can Drive My Car, in that case, it looks like it is pausing a little bit, just like oil is, and probably inventories matter a lot, and sometimes inventories matter. Sometimes they're on ships, sometimes they're in short supply in a region, so you just don't know. My gut feel is that this is a pullback of some kind, even though it's in a rounded top, which means it probably isn't going to go any higher in the near term, because that is a very good pattern for basically eliminating or reducing the possibility or the odds that something is going to go the other way. Copper has also broken down, which is kind of interesting when you think about it, because some of the base metals have and some haven't. Copper is probably about as basic of a material as there is. I mean, people even steal copper piping from houses when they're basically dilapidated and they're in the hood and they're abandoned. Believe it or not, they will steal copper piping. It's one of the activities of the mob. Not that I would know, of course. All right, so let's go. This is the Invesco Agricultural Fund. All right, we do all eat food, I believe. Even Ace eats food, and apparently food prices are going up, but it's broken down from its parabolic trend. So it may be that food was just skyrocketing because it was in short supply. It may be pausing, but it's still gone up quite a bit in the last year, and you're going to be paying a hell of a lot more year over year, and I don't think it is going to retrace this move. I mean, I highly doubt it, especially with all those dollars out there that are eventually going to cause inflation, eventually. Actually, they already are. They're just not showing up in official government statistics. All right, so here's a yield on 10-year treasuries. This one, I make some crummy calls. I'll be the first to admit that. But this one was really good. I mean, I said that if it broke up above a percent, which is where the horizontal line is, the resistance line, that it was not only in a rounded bottom, it had resistance at 1%. If it broke 1%, it was just off to the races, and it's now at 1.7%. And another reason why today's move up in equities was somewhat suspect is because interest rates went up a lot today, and they now don't normally do that. Now, especially when the 30-year goes up in rates, it affects tech stocks, because tech stocks are like the longest term duration bond there is. They're more sensitive to interest rates than even a 30-year bond. And the reason for that is that they have these multiples which count past year 30. They're basically perpetual. They're like annuities. They're perpetual, except they're growing annuities, and the multiple can shrink. So in other words, they can still grow their earnings. They can still be doing very well, but they don't trade at a 40 multiple anymore. They trade at 15. And so all of a sudden you've seen 60% drop. Nothing bad has happened. That's what happens in the market. Valuation is key to risk. If you buy something too high, your risk is going to be extremely high, and your probability of return, not to mention the amount of return, is going to be very small. If you buy when something is low, okay, the amount you can lose is very small, the amount you can make is very large, and you can buy low and sell high. We try to look for stuff like that, and not stuff that's like Amazon trading at $3,400 a share. I'm really not looking for that kind of thing. And I will let all the April Fools run in, only fools rush in. Or as they say, a fool and his money is soon parted. Where's my money, by the way? I seem to have run out of it or lost it or something. I wonder if it got stolen. Anyway, I'll look around for it later. Anyway, that was 10-year Treasuries. So we're going to go to, this is now the 20-year Treasury bond ETF. This is how you do if you'd actually held a long-term bond. Let's say you wanted one just for the hell of it. You couldn't get yield anywhere, so you bought a 30-year bond or a 20-year bond or a 25-year bond from the Treasury. And you collected your fabulous 0.8% coupon annually, okay? So this fabulous coupon you're about to get and this incredibly safe bond at the same time, well, it didn't work out so well. What you'll notice here is the thing looks like it's basically falling off a cliff, which is exactly what it's doing. It's cascading off a waterfall. It's like a cascading waterfall. And you have lost 20% in a 20-year bond. 20-plus year bond ETF. Safe, huh? Isn't that what you'd like? Not me. I'll take stuff in dollars under the mattress before I do that. All right? So here we go. These are 20-year Treasury yields. Look at that thing. Just flying off the charts. And the thing I keep emphasizing over and over and over, and I'm sorry to be repetitive. That sounds like a law firm, though, doesn't it? Repetitive. Never mind. No, that would be Leibowitz, and Jones. All right, so 30-year Treasury yields. They're now at about 2.4%. 2.4%? Jeez, I've been around since the beginning of time. Let's just say since the beginning of time, since there was even life on Earth, when sludge first crawled out of the ocean, I was alive. And I saw all this, so I know history really well. And I can tell you that 2.4% is so cheap, I wouldn't be surprised to see it triple. And the historical average over a long period of time is about 7%, and there's no reason why it has to stop there. I mean, during my lifetime, all hundreds of years of it, I look pretty good for a couple hundred years, don't you think? Yeah, I know, it's the menin, it's the Grecian formula does it, but I didn't tell you that. In any event, the 30-year Treasury could easily go to 15%. It was at 15% when I was just a wee lad, and the horse was coming by to take me in the carriage to my little school with my little my little book, and we're reading about Little Women and stuff like that, way back when. So we haven't seen yields like this ever, and that's why I'm saying when you have that perspective, these just look ridiculously cheap. But if you're not that old, let's say that you're like a regular, normal person who's not basically 1 foot in the grave like me, but you will not remember that because interest rates have been coming down for, are you ready for this? 39 years. 1982 was their peak. Paul Volcker was the chairman of the Fed, not Jay Powell. Paul Volcker, all 6'8" of them. And he's the guy that basically broke the back of inflation. And 38 years later, the bond yields went to zero. All the time that did was basically buffet the market. And that's why we've had so few bear markets during that period that have been severe. Yes, we had the dot-com period, and we're going to have some nasty ass one coming up. I can tell you that right now. But if you see a 20% move caused by this move in rates only to 2.4%, imagine what you're going to see in the capital price of a bond if it should go to 8 or 9. Not pretty, especially if you're a financial institution and you own them and you borrowed to own them, which is what a lot of people do. It's called playing the spread game. And the spread game works until it doesn't, and when it doesn't, it really doesn't. So you have to make sure that when you're playing a particular kind of strategy or trade, you realize that they are limited trades. They're not going to go on forever. I mean, our rates were not going to go to minus 20 or anything like that. Where could they go? They could go minus. You could be like the Swiss who actually had a bond 50 years in maturity and with a negative rate, and people bought it like there was no tomorrow. So you can't explain an irrational market. That's all there is to it. As John Maynard Keynes said, market can stay irrational longer than you can say solvent. And given the fact I'm not sure exactly where my money is, because I told you I'm a fool and his money is soon parted, I have a feeling he's right. Anyway, this is the ProShares Ultra Short 20+ year Treasuries. This is one of the best things out there. Sometimes they come up with really great securities, and this one is the ideal security if you are somewhat exposed to longer term rates. Let's say you have a variable and you can't get into a fixed. I would maybe hedge it with this, because this thing pretty much will take out all the capital risk that you are taking on with a variable loan. So, and maybe you have a long-term lease somewhere that's going to escalate with the price of inflation. I'd buy this, okay? Because you're stuck with the lease, it's going to go up, and the numbers are going to go up, and this is the only thing that's going to protect you from, okay? Now we're going to talk about Apple. Apple's important because it is worth so damn much money. $2.4 billion, more than all but 7 countries. I know I've said that before, but we always have new viewers. And so I want to make sure that all of you people, wonderful people, know that this is how you define a mania. Unsustainable valuations that people just accept as normal. It's like the Dutch tulip mania, where people have somebody sold a home for 1 tulip. That was a good trade, huh? All right. So Apple kind of looking bearish. It was the first one to turn bearish, and it started to give the first red flag that something was awry. Amazon has now broken down too. It was kind of in a triangle. It's broken down, not really looking too bad, actually, considering, but didn't go up a whole lot today either, and the market rallied like crazy, and you're not seeing these things rally very much. They're just kind of going along with it more than actually really participating in it. And you hear Ace growling back here. You may hear him growling. He hates this explanation of Amazon. He doesn't even like Amazon because the dog food there. He doesn't like their dog food. What can I say? Facebook. Okay, so I've checked a few facts on Facebook. And one of the things I've learned about checking facts is that I cannot prove that there's a human being actually in their offices. And the reason I can't prove there's a human being is because there's no listing. And the reason I can prove Facebook is there, I can prove that fact checkers write boilerplate, but I can't prove they're fact checkers. In any event, it's still looking pretty good. They were grilled yesterday. Mark Zuckerberg and I think the head of Google and I think Microsoft, we're all grilled about basically the monopolistic practices and the invasion of privacy. What a surprise. Like, we all don't know that we're being watched. Somebody's watching me. You know that song by Rockwell? Yeah. Okay. Google, still in an island top, continue to draw it. This would be the time we might just see it, that gap down on Monday, because I think Monday very well could be a gap down because of all of the fluff in the last half hour. Otherwise, good chart. Microsoft, also a good chart, except maybe a rounded top here. And that is the first sign that it might break down. It's right at support right now. And as a matter of fact, it may have just today or the day before just perceptibly broken down. I wouldn't consider that quite definitive yet. I'd like to see it break down through the neckline, the red neckline of the rounded top first, before I decided to make an opinion on it. Netflix continues to move sideways. Nothing new here. Tesla, I love to talk about Tesla, and I can't wait to talk to Elon at the end of the show. But One of the things I'd love to rib Elon about, we saw Bitcoin had gone down. Remember I told you head and shoulders pattern? Well, here's a company that needs to constantly raise money, Tesla, because it never makes money, okay? This company never makes money. I mean, yeah, they might show an accounting profit, but the reason they show an accounting profit is because they sell carbon credits, or they manage to have cars that get federal credits. Without the government, I'm not sure where this would go. And at the very end, it's not electric vehicles are only going to be about 10% of the vehicle population anyway. So I don't really understand why this makes this so incredibly valuable, but it does. And the thing is, it's going down from here quite a bit. All the foam has come out of it. And you look at this thing, and it is a very good gauge of the stupidest sentiment out there possible. This thing is just hope. Although it has some assets. I'm not, don't get me wrong. I'm not saying it's valueless. I'm saying it's nowhere near what it was worth at one time. Okay. And this is kind of interesting. There's become a new industry. I don't know what the hell to call it. I'll call it delivery or the GPS. There are companies that share GPS probably. But again, they don't make anything. They take hamburgers from one place to your home, not usually where you live. You always have to dig around and find them. But again, amazing multiples for a company who has no barriers to entry at all. If there were, you wouldn't have Postmates, Instacart, Lyft, Uber Eats, blah, 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 blah. And then you'd also have Domino's would be worth about $20 billion because they even make their own food. And I think they even own their own cars. And so, they deliver, they make, and they have cars. And they have assets. So I would say that company should be worth $20 billion if this one is, and it's not. So, and this is Lyft. Lyft just announced, and it rallied on this news. It just announced the other day that it had more people riding in Lyft cars than any time than last year. Last year, what was going on exactly a year ago? I don't know. But people were not riding cars, and the Gestapo was basically telling us to stay home. So, of course, they're going to have more driver miles than they did before. And, they make up it. They have the worst business model. They make up in volume. They lose on every ride, but they make it up in volume. Perfect. And so does Uber, by the way. And you look at Uber, and it is also a bearish rounded top. And these are all companies with bloated multiples, no assets, and no hope in the near future. Oh, of course, they claim they're going to make money, but then accounting and projections are always a fiction. Basically, there's so much leeway. So in any event, we're going to go on to 37-year Treasuries. This is how you would have done if you had held one. You wouldn't have done pretty well. You wouldn't have done well at all. And that's a very safe bond. So this one's a 7 to 10-year Treasury. You lose 10% right there. That's supposed to be a very safe bond. These are investment-grade corporate bonds. You would have lost 10% there too. These are double A credits, single A credits, not necessarily anything but that. But they've also gone up because interest rates have gone up, and they trade at a premium to the rate that is consistent with their duration. So in other words, a corporate bond that has a 10-year duration will trade at a premium to the U.S. Treasury at a 10-year duration, usually, and that premium can vary depending upon the credit quality. This is the bank index. It's been going like crazy because, as we all know, higher interest rates must be good for banks. And this thing has finally broken down. Believe it or not, banks have kind of lost their fuel. And this thing looks like it's pretty close to breaking down if it hasn't already. A couple of the banks have, a couple haven't, but you start to see cracks before you see the whole thing fracture. This is a broker-dealer index. All those new deals, this is like Goldman Sachs. They basically mint money with these IPOs. And these IPOs, they call them unicorns when they're over $1 billion. It used to be that $1 billion was like a mid-cap and almost a big-cap company. Now they're just bringing them out as IPOs. SpaceX, which I love to make fun of. I don't love to talk to Elon about it. It's going to come out at $74 billion. And Jay Powell's asked me for a couple of first-class tickets on it. He doesn't know. He just doesn't know that it's going tomorrow. That's for investors only. Because see, the thing is, if you don't actually make it, okay, it's so dangerous and so technologically difficult. Who's going to sue you, right? You're going to put it in the private placement memorandum that all these things can go wrong, and you raise all this money. You basically build all this hope, and what happens? The guy fails, and you have a perfect excuse built in for why you failed. Anyway, S&P Bank ETF. This one is more regional banks. Again, broken down, parabolic. Banks should not be going parabolic. I mean, that's just crazy. American Express, real close. This one has been a leader, and you look at that rounded top, right there on the cusp. Berkshire Hathaway, again, Warren Buffett has done phenomenally well here, even though he's underperformed apparently the S&P for the last couple of years, but it's still doing okay right now, and it's holding within its trend line. But on the other hand, these are all banks. He owns banks and Apple, pretty much. He owns Chevron. So if the market goes down, he sure as hell is going to be affected. But the one thing he does have is tons of cash. This guy holds on to cash like nobody's business. So Discover Financial is another credit card company. The reason I put it in is because it's indicative of retail sales possibly, and those are 70% of the economy. Discover just broke down beneath a rising trend line, and actually a parabolic trend line. I hate saying that about credit card companies because it never should be parabolic. Come on. Okay, this is S&P Regional Bank ETF. Again, these are sort of regional banks, like Bank of Tuskegee, Bank of Whippoorwill, something like that, and these are doing well too, except they are breaking down now. So there is a problem. And the problem may be in what they hold, the problem may be in higher rates, but there is definitely something going on. And we're going to see some really interesting fireworks here. And that's what we love, is bringing it all to you and making sure that history is preserved and not, oh God. Cable news is the leading cause of mental illness. Those of you that have a TV, please keep that in mind. Now, eventually there will be some kind of device which will, basically mitigate the radiation and the brain waves which come up and brainwash you and make you mentally ill. Fortunately, I didn't watch too much of it, I think. But, I did for a while have that, did have some problems. Cable news, don't watch it. Okay, JP Morgan, again, it's broken down out of it's a parabolic phase, and it looks like a little head and shoulders top. So all these things are making topping patterns even when they're not necessarily topped. And that's the key. Nothing makes a top at the same time. They do it at different times. And what happens is at a top, you start with a few, then there's more, then it's pretty much market wide. And that's what's going to happen. That's what we're watching happen. That's what we've been talking about and watching happen for the last several weeks. And if you notice, lots of companies, they look kind of neutral, then they turn over. And that's what's going to keep happening. MasterCard, it actually started to rally, and last week on Friday, it just plunged. Now this one, it's sort of consolidated a little bit, hasn't really broken down, but I didn't like the way it acted on Friday, so that's why I included it in here. Because again, MasterCard handles so many transactions that it's got to be very indicative of the economy itself, as is Visa. And Visa broke down from an ascending wedge, and it looks not so good, and it did on huge volume. I mean, lots and lots of volume, like shouting volume, that kind of thing. Okay, so here's some of the sectors we're going to talk about. Biotechnology. Well, I guess all the gold rush in making vaccines has ended, or it looks like it has, and they're all kind of going down. So that's one thing right there. Big Pharma, of course, has also broken down, and Big Pharma. Big Pharma is huge. Basically, we're talking about Merck and Pfizer and Bristol Myers and Abbott Labs. These are all making vaccines, see? And they're not making that much money at it because it's competitive. The weird thing about this, I remember vaccines being made for various things, but I've never heard of like 100 different types of vaccines for the same illness. I've never heard of that. I'll ask this question again. What happens if you're a doctor, you recommend vaccine A, and vaccine A kills a whole bunch of people when you were given information that vaccine A was perfectly safe? I don't know the answer to that question, but I wonder. Big oil, it's also turned down. If you notice, it kind of broke out. We said 950 would be a good place for it to break out. It did just basically, just barely, and now it's turning around. And the fact that it's turning around is somewhat ominous in that it means the demand has likely gone down. Because the supply, yes, the supply may have gone up too with shale, but there also could be a demand issue, even though, from what I read, the airlines are soaring in traffic. So who knows? All right, the healthcare sector is an entire, the healthcare sector, this includes everything. And the healthcare sector has also broken down 1/6 of the economy. That is not a good sign. And especially when you have an economy of aging people who you would expect require more healthcare, that's not a good sign. So this is my favorite, is the airlines. Now, I still cannot come up with a good explanation for this. How is it that you're rallying to new highs when you're operating at 1/4 capacity, your planes are sitting dormant, which you still have to pay for? You have to pay for your portion of the gates, leasing them. You have to pay for your portion of the land at the airport. You have to pay for the jet you own, whether you fly it or not. And you probably have to pay some people who aren't working because they're unionized. So there's no reason for these things to be going up, except the fact that possibly the people who are buying this are also enjoying the cannabis surge. I don't know, purely speculation on my part. The Dow Jones REIT index, this is real estate investment trust. So it's really large holders of real estate. They can include malls, they can include residential housing. They're right at a point of basically breaking up, but not quite. And they've got a headwind, which is higher interest rates against them, and they've got a tailwind, which is a lower dollar. Unfortunately, right now, the dollar's going up, so they don't have a tailwind at all. They will eventually, because as the dollar does diminish in value, and how can it not when it's being just thrown around out there like crazy, stimulus here, stimulus there. 140 million checks just got sent out, or I think 100 million, 90 million have already arrived. Of course, mine hasn't. Thank you very much, Uncle Sam. Anyway, the REIT index, it's looking okay. From a long-term perspective, real estate probably will do okay. During the 70s, when we had stagflation, yes, I was alive back then. I was alive a lot earlier than that, too, by the way. During the 70s, we had stagflation. Real estate went up, believe it or not, so did rents. And see, that's the thing. Real estate throws off a growing cash flow, kind of like a growing annuity. And when rates go down, these become incredibly valuable. The problem is rates aren't going down. So they're fighting a headwind. They might, utilities, same thing. I mean, basically, utility is a growing, consistent stream of income because they're local monopolies. But they cannot fight higher interest rates if they're moving up too fast. So that's something to keep in mind. And sometimes utilities can make phenomenal investments if you buy cheap enough. I remember way back when I was a child and I was trudging to school through the snow and had no shoes and had no lunch, and we were so poor that, never mind that. But anyway, I don't know what I was talking about, but real estate is always going to be a good investment. And right now, especially in a commodity phase, yeah, the inflation part's going to hurt, but if you own real estate, it's not going to collapse like a lot of people think it is, simply because the dollar is going to much more likely. They're not building more land, but they are printing more dollars. That right there should tell you real estate will go up. Okay, UPS is a great deliverer of goods, except when it comes to my goods, they leave them at the wrong place almost all the time, and I have to go find them. But they are pretty important, like the brown uniforms, yeah. But bearish rounded top. It looks like actually they may have broken up. So you have to keep in mind that when you look at certain charts, they tell you something other than what you believe overall. I call that a worldview. This one would dispute my worldview. My worldview is basically market's going down pretty soon. This one right here tells me caution. Just make sure that this thing, doesn't lead the way up. And FedEx 2. FedEx 2 it's not a bullish pattern the same way that UPS is, and UPS may not be a bullish pattern at all. They're still within the confines of a rounded top, maybe a little bit of sideways action here, but nothing that looks like the economy's growing like gangbusters. Like everybody's saying, oh, it's going to be up 8% in the first quarter. Oh, it's going to be up 6% in the first quarter. Oh, well, let me tell you something. GDP growth is really easy to figure out. How many labor hours increased and how much productivity increased. So if you're paying people not to work, like as in using unemployment benefits, you're paying people not to work. They're not going to work. Okay, they're not going to work. And I know it's completely legal and it's so compassionate, but makes no economic sense. Just like 0% interest rates, what they do is they end up having people misallocate capital, and you're going to have a bunch of really bad projects that were only feasible at 0%, and when rates go up to 5, 6, 7, they're no longer feasible. You got to tear them down. Walmart shoppers are tapped out. We've talked about that before. This is very indicative that the economy may be slowing down. And I thought I had some more here. Well, I guess I don't. So what I want to say here is thank you very much for coming. And we're about to we're going to come back in just a minute. Please like and subscribe. The call with Elon Musk is coming right up. It's going to be a hoot. I guarantee it, because it never is not a hoot with that guy. And especially given the time, it's right about 4:20. So we'll come back in just a minute. Thank you very much for tuning in, but don't go away. Well, welcome back, everybody. We're going to call Elon Musk right now and be prepared for some funny action here. All right. Let's see. Let's call him. Elon, please. Yeah, this is Marko from Hoot Loot. It's Marko from Hoot Loot. It's not, no, you idiot. It's not Fruit Loops, it's Hoot Loot. Are you stoned back there? Does he like have the whole office wasted? Oh, gee. Hello? Hello? Oh, that was a good use of time. Well, anyway, I want to talk about this new feature that we have. It's called Learn and Earn. Okay? Now, if you can get the correct answer to this question and email it to Markonomics101@gmail.com, you will win $50 if you're the first. And they're all time-stamped. That's all know. Okay, so the question is, the Dow Jones Industrial Average, the NASDAQ, and the Standard & Poor's are all constructed differently. They're all measured differently. The Dow is the exception. How is the Dow different than the other two? If you can get that answer, send it in, and we will see you on Wednesday. Thanks for tuning in. Don't forget to subscribe, and you have to be a subscriber to win.